but so I will be brief about it. But if not, it's important for you to know that SCORE is a national organization, and our goal is to foster vibrant small business communities. And we do that through mentoring, and we do that through education, like this workshop. It's very important for us to give every person the support they need to thrive as a small business owner. And we do that perfectly free. There is no charge for our services, no charge for these workshops. We have actually the largest network of free volunteers for free volunteer small business mentors in the country. We have over 10,000 people. And so no matter what stage you are in, whether it's idea generation, whether it's starting a business, whether it's growing a business, whether it's preparing to exit a business, SCORE has a mentor for you. We like to serve all demographics. We have hubs for each of these demographics and for more as well. So we want to empower all entrepreneurs to succeed. And it's super easy to request a mentor. All you need to do is go to the score.org site, which you can see at the top in the address bar, and enter your zip code so that you will get a local mentor assigned to you. Once you enter the zip code and choose request a mentor, you will have a small form to fill out, and that form asks you what kind of mentoring you want or what kind of business you have. Be sure to be as specific as possible in your request so that the match can be made, as a good match can be made between you and your mentor. Again, we are supported by the Small Business Association, so we can do all of our work for no charge at all. We don't get paid and you don't get charged. Here is our code. Feel free to take a picture and it'll take you right to the website, www.score.org. It is a very powerful site with many, many resources. It's very rich in resources, and you can request your mentor there. Okay, I am going to stop sharing and turn the meeting over to Liz Patrick, who will introduce herself and begin the program. Thank you.
Thank you so much, Sharon. Good afternoon, everyone. My name is Liz Patrick. I'm Vice President of Lending at Comstar Credit Union. I have worked at Comstar Credit Union for over 13 years. I started out on the front line as a member service representative, and then in 2015, I joined the loan department and have been working as a business loan credit analyst. I've worked as a business loan underwriter and a business loan officer since 2017. I do have certification through the Credit Union Business Lending School, and I'm committed to helping businesses achieve their financial goals. And I really hope that you find both part one and part two, which is today, as beneficial and valuable. I am also going to request that you do refrain from asking any questions until the end where we have our Q&A portion. But I will now start my presentation. Alrighty, so thank you again, everyone, for attending part one of this series, and welcome back. In part one, as a refresher, I covered submitting the loan application package, the loan presentation, and the first two legs of the business loan department stool, which is the loan officer and the business loan committee and the committee vote. In the second session, we're going to focus on timelines on when the loan starts booking, the business loan, as well as underwriting, which is also known as the dream killer, which I'll discuss more in detail on how that nickname was funded shortly, final approval, funding, and what to expect after funding the loan. So first, let's see the average timelines from the loan application submission to the finish line. So you'll see there's a lot going on in the background, and many of these will coincide and overlap, but it will give you a general idea of why you will not have an answer overnight. Again, each financial institution does things differently and have different processes, but there is a consistent standard that a lot of financial institutions follow. So if we review this, the loan packet prep, that could take 1 to 4 weeks, depending on how much information that needs to be included in the loan packet. Loan officer review, running spreads, setting up the presentation, that can take up to a week. Loan committee review, 1 to 4 weeks. It could take a little bit less than that, but that's generally a standard. Underwriting, definitely the loan amount will dictate that amount, how long that might take. If it's, above 50,000, it's going to take a little bit more review. Appraisals, it can vary as well. Generally about 2 weeks, but it can take longer, especially if there's an issue and you have to dispute it. Environmental can take up to 12 weeks. There's, a phase 1 and a phase 2. Closing documents can take 1 to 3 days. Title work, 1 to 4 weeks, and funding, setting up the lender, notary, signer schedules, that can take a couple of days as well. As we go on to the next slide, let's revert it to underwriting. So why is underwriting considered the dream killer in this presentation? Well, years ago, there was a lady who worked for our local SBDC through the college, and she was a commercial loan underwriter. So literally any request that would cross her desk, she would just decline or recommend to not approve, essentially killing the dreams of many small businesses. And that is how she got that nickname as the dream killer. But as someone who personally has underwritten business loans, I have to say that's not always the case. We're not always these dream killers. While underwriting is a separate entity from the loan officer, it's really important piece of the business loan approval process. Underwriting evaluates the loan application package, determines the risk and credit worthiness of a business and its principal owners. So let's discuss in more detail on the next slide regarding how underwriting works. So underwriting, they can be considered as disinterested third parties. They generally just review the submission objectively. They review the credit history of the business and the guarantors. They evaluate the business plan and analyze revenue projections and the growth or potential of the business. They also conduct a financial analysis, calculate cash flow, confirm the submitted documents are accurate, and many other things in between as well. I'll mention later in this presentation that underwriting also has a score matrix evaluating the risk involved in your loan request. This is also underwriting's first look at the application package. So there's going to be additional questions that might go to the loan officer that'll go back to you. What underwriting does is they want to protect the safety of your business, make sure that you're in a position to take the loan and also repay it. Underwriting is also looking out for the safety of the financial institution as well, as they have regulations to follow. Personally, I have experience underwriting with a no recommendation for now. And while it might have worked at the time, the borrower has come back and it has revisited to get to yes. Regarding regulator function, underwriters ensures the loan request meets regulatory and internal lending guidelines. Financial institutions regularly have examiners in to review loans, and underwriting confirms that they're compliant and within guidelines, and any exceptions to loan policies are noted and supported if need to. Underwriting also uses the information that you provide to determine whether to approve or decline or recommend decline, as well as determine terms, conditions, and interest rates. As we go to the next slide, as your underwriter is reviewing your loan request, your banker is essentially now your liaison between underwriting and you as the business owner. As Dan said it perfectly in the first session, it's important to have a strong business loan officer and the impact that they have for the success of your business and loan request. So when underwriting requests additional documentations or explanations, underwriting will reach out to a loan officer, which will then reach out to you, the business owner. So you might think that some of these docs they're requesting are irrelevant to the process. You might have advised that you've already given them their documents, or underwriting might ask questions that you think you've already answered, or ask questions regarding those explanations. They may seem excessive, but underwriting has the power to say yes and approve to your loan, but they also can say yes with additional or different conditions to the loan. So they're just really trying to mitigate the risk on your request. And that's the reason why they're asking so many additional questions and maybe asking for additional paperwork. If they do say yes or yes, however, we need to update some of the conditions or covenants, that could mean that your previous commitment letter will have to be reviewed and revised. If they do state, not to recommend, generally it would be a decline. However, it does not mean it is always going to be a decline. I've seen that in cases personally. The committee can determine mitigating circumstances such as a higher liquid assets or lower LTV or sufficient cash flow to help mitigate, again, some of that risk. So this brings us to the next slide. Underwriting will also have a matrix, which was discussed in the previous section. Underwriting will be more conservative on their matrix because their goal is to analyze and reduce the risk while also maintaining compliance regulations. So a quick look at this. Again, the score matrix 1 to 10 is generally that scoring. Most underwriters look like the 2 to 5, whereas the committee looked for 3 to 6. Score factors very similar: debt service, transactional, and global. Credit scores, loan to value, collateral type, business profitability history, past loan performance, whether it be with our financial institution or other financial institutions, and also take into consideration SBA as well. So on the next slide, in this case, you've got your yes, your approval. So let's review the next steps. Will the commitment letter need an addendum? Are there new conditions or covenants the borrower needs to follow? Another conversation between the loan officer and the borrower needs to be had to have it signed and in writing to get that updated commitment letter. After that, get third-party work ordered, get the lien search started, surveys and flood certifications, review everything, make sure there's no liens on the collateral, and everything is in order. Also, when you get the appraisal back, review and confirm the value of the collateral to determine that there are no discrepancies. Once everything is in order, we can check out and order the docs, the closing doc package, and review for accuracy. After that, we get the clear to close. The clear to close is a common real estate term that means all conditions of the loan have been met, final review has been completed, and a closing date and time can be scheduled. So now we're here at funding. So congratulations to making it to funding day. This occurs after all closing documents are signed on closing day. As we transition to the next slide, I'll discuss a little bit more on the do's and don'ts of closing day. So let's discuss some do's and don'ts. So you want to have a clear understanding of the closing costs prior to and the closing docs. You can request your loan officer to review the docs prior to closing day, so you're well versed on what you're agreeing to and signing. You want to understand the disbursement and the fees. Fees can include closing costs such as appraisals, title work, UCC filings, underwriting fees, doc fees, origination fees, environmental fees, and SBA fees if needed. These can change based on loan type and loan amount. And also they may be required outside of closing as a condition of the loan as well. These fees are generally itemized on the commitment letter as you sign, as well as the settlement statement at closing. Additional disbursements are completed based on the type of loan, such as refinancing a debt or a purchase. It's important to show up on time and respect the notary's schedules and sequences. They also have other loan signings and their time is valuable, just like yours. It's important to know who is or who needs to be in the room with you. Is it guarantors, spouses? The loan officer and title company or notary should let you know in advance. There's no right of rescission. So that means this transaction cannot be canceled. And so once the loan docs are signed, it can and will be funded the same day. Some don'ts, obviously you don't want to be late, because that follows the second C of credit that we discussed in the previous session. It's character, which can also delay funding, and a notary schedule, which can set other people's behind. I recently experienced a business owner's notary was late due to a previous signing. It actually went 4 hours over, putting everyone behind schedule. And it just was it was kind of a disaster because everything got pushed back even further. The loan officer has clearly stated the terms of the loan. So it's important to not renegotiate the terms at closing, as well as, do not try to renegotiate the covenants and the conditions. You should also have had time to review this. And if you forget to bring all signers as well, that could delay funding, and that could mean additional fees such as redrawing docs, because new docs will have to have new dates and everything like that, or notary reschedule fees, which occur as well in the event that the loan docs do not get signed or funded that date. So once everything is signed and the loan has been funded, what do we need to expect? Let's discuss on the next slide, life after funding. And it's important to know your lender will check in periodically and conduct site visits and or request updated financial statements to confirm that the collateral is in good shape and the business is in operations and is continued to be viable and remaining viable during the term of the loan. We also want the success of your business. So if you have any questions during that time, we'd love to, work with you and speak with you about potential other options as well. So regarding periodic reviews, the loan balance can influence cadence. So our financial institution, if it's above a certain amount, we don't require an annual review. However, if we do see delinquencies or if they're not paid on time, that could mean that we would ask for financial statements and stuff like that more frequently. We do review covenants and the conditions that were on your loan documents to confirm that you continue to follow those and agree to them and are adhering to them. We also review insurance, make sure taxes are current, financials, make sure the business, again, it can repay the loan and there is still sufficient cash flow during this time frame as well. Payment history, that's very important, maintaining on-time payments, which really helps particularly with the renewal process, which we'll discuss later on. Monthly, the lender will report SBA loans for their guarantee, also just confirming to SBA to let them know that the loan is being paid as agreed and is also following the terms of the credit memo. Participant reporting, I'm sorry. Again, same thing, monthly balance reporting, principal and interest payments towards specific percentages based off of the participation. We're essentially informing the other financial institutions that have a piece of the loan that they are remaining compliant, and there are following the loan conditions and covenants, and the loan, again, is being paid as agreed. Also, during periodic reviews, we're preparing essentially for term maturity. And what term maturity is, it goes into the next slide of renewal and that renewal stage. So roughly 6 months to 12 months out, I start reaching out to my business owners prior to their renewal. And I start having conversations. I schedule a time to discuss the previous terms of the loan, seeing what their interest is in doing. Are we, do they intend on renewing the loan? Are they going to further extend the loan? Are they going to try to term out? I confirm, their payment history and, let them know whether or not they've been abiding by the covenants of the loan and the conditions. I think it's really important for the borrower to know the market. It's including current industry risk, as well as rates. Are we in a raising rate environment, or are we in a dropping rate environment? I mean, I personally have had a few conversations already with business owners whose loans are expected to renew in 2025. And their main concern, honestly, is rate, because the market has changed so significantly since 2020. And they may not be able to get the same rate that they did in 2025. So it's important to discuss the best time for renewal, even if it is before maturity. And it's also important to understand that a lot of this process during the renewal is kind of starting over. Like, we have a lot of your information already, but we still have to do a reconsideration of value of the property, still have to order title work for this new loan. So there's still going to be a time frame involved. So that's why we want to make sure that we're ahead of it and working towards it. It's important also to be prepared in the case of LTV. If the collateral drops and as we do a reconsideration on value or appraisal during the renewal term, that could change the future loan amount for this type of loan. There may be some UCC adjustments. And if there's an issue with cash flow or other outside factors, that could also impact the renewal process. Regarding term out scenarios, we can consider another, 5-year, 15-year amortization, or, maybe something, just a complete term out of a 10-year term, fully amortizing loan. But, each financial institution has different processes. So there will be some consistent standards, but the conversation is going to be very similar. And remember, again, that we are reaching out to you earlier because this process can take time, as discussed previously with the previous session and with the timelines. So regarding renewal, there is an opportunity where the lender is not obligated to renew. I've experienced this a few times. The borrower would need to either pay it off or refinance it elsewhere at renewal, which is another reason why your financial institution is reaching out to you 6 to 12 months to maturity in the event that we're going to have to part ways, unfortunately. It's important to understand being a good borrower is very important. Keeping conditions and covenants as agreed, providing review documents in a timely manner, adhering to the conditions and covenants of the loan, and understanding the importance of that can also help renew this loan as well. Another item to consider is concentration risk. If I know we discussed this previously, at renewal, if there might be too much loan dollars in a specific retail, like whether it be retail or specific business sector, we might not be able to renew the loan. The participant might withdraw, or multiple participants might withdraw, which means that you wouldn't be able to get the full funding for the loan. And the reason why that could happen would again be due to a lower amount when they review the collateral, maybe cash flow, delinquencies in the past, or something along those lines as well. But it could also be due to their concentration risk. Market forces, again, if it's a volatile business sector, that could determine whether or not the lender will renew. Rate opportunities is also an option as well. And if the financial institution decides to consolidate and not do as many business loans, that could also affect that as well. So just to sum everything up, I hope you have a better understanding about what happens behind the financial institution's curtain. I think it's important to understand that your financial institution and your loan officer want your business to succeed. You know, they advocate you and will assist you with the renewal process. So as you know, like I said, as we wrap up, I hope that you have a better understanding about what happens and what occurs from loan application to package to funding. Again, while these vary different from financial institution to other financial institutions, these are generally the consistent standards. It's important to know that there are just as many exceptions as rules. And please, again, here's my contact information so you can reach out with any questions or clarifications that you might have. And thank you, SCORE. I appreciate all your help for hosting this series. And so now I guess I can open up for Q&A.
That's terrific, Liz. Thank you so much. I am looking at the chat and I don't really see anyone who put any questions in the chat. Does anyone have any questions for Liz? She's provided just a wealth of wonderful information. And anyone? Liz, you might be home free.
Oh, wow. Yeah, I know it's a little bit brief,
Actually,
but
click raise your hand. And you've got a nice compliment from someone. And
thank you.
when we're done with this, I want to tell everyone about a very special event that SCORE is having that you might be interested in. But let's anyone else, anything for Liz? This was packed full of information. Okay. Thank yous, and people will probably contact you, Liz, which is fabulous. Okay, here's a question for you, Liz. I don't know, are you watching these or no?
Yes, yeah, I am.
Okay. So someone had a question at the end there.
Yeah, absolutely. So it looks like Jim asked, how many years should someone be in business to ease in the loan process? So actually, that's a really great question. I appreciate that. We actually work with loans for businesses in all stages of life. So you could be a startup business and there is an opportunity for a loan for you. We would take into consideration other forms of income, whether it be, W-2 wages or spousal income or maybe another guarantor. But there is definitely an opportunity. We would request that you work with your SCORE mentor regarding establishing a business plan with projections, so we can also take that into consideration when reviewing your loan application.
Great.
Thank you, Jim.
Thank you, Jim. Anyone else, any specific questions? Just go ahead and enter them into the chat there. Liz?
Yeah, absolutely. I know there was a question about starting, she needs help starting, how do they start a group home? Yes.
Yeah, I can take
I
that.
think that, okay,
Yeah,
perfect.
why don't you go on to the next one? What if someone has a year of positive cash flow?
Okay, yeah, excellent. So if someone has a year of positive cash flow, that is very helpful. We can definitely review that on the transactional side for debt service coverage. And we do take into consideration the type of business that you're in, as well as the future market. So we'll definitely take into consideration that, look into your potential future earnings as well. And if we need to, the support of any additional sources of income.
Okay, and then there's another one, which is better to get a loan through a bank or through a lender.
Uh, I guess it depends. I don't think it's whether it's better. I think the processes are very similar. I don't know what you mean by between bank or a lender exactly, for me, like a different financial institution. But I think finding the right financial institution for you that has what you're looking for, and the loan type that you're looking for is the best way to go about that.
Okay, so while we're waiting for any more questions, starting a group home and a food catering business, let me tell you, we have on score.org one of the most downloaded webinars, in addition to Liz's, on starting a group home, and we have experts who can help with that, who are mentoring many people on doing that. And for a food catering business, again, we have expert mentors on in all kinds of hospitality, food catering, food trucks. We have a whole hub on food trucks, and I think one on group homes is going to be coming soon. So your best bet for any of those specific things is to go to score.org, and you can go to score.org/Cleveland and request a mentor, and make sure that you put in your job description that you're interested in starting a food catering business or interested in starting a group home, so that you are matched to the mentors who have expertise in that area. Liz, I think there's some more for you in here.
Absolutely, yes. So one person asked, are there specifics for an SBA loan as to how much you have to have yourself? So that can vary actually based off of loan amount, and as well as your lender comfortability. SBA generally helps mitigate the risk of if there is a collateral shortfall or a down payment shortfall. So you're looking at like a range between 10 and 20% that you have to show some sort of equity in. Regarding the question about securing financing for a potential contract, I might need to look a little bit more deeper into that, and ask you a couple questions. I would like, if you could reach out to me, I would like to discuss that a little bit more, if that's okay.
Great. And once again, we will be sending out a link to this recording and the slides within the next couple of days, and then it will be posted on the score.org website as well. Any other questions before I talk to you a bit about this event that might be very exciting for you? Okay, Liz, we'll see if there are any more questions that come up. Let me share my screen here for a minute again. And we are having an event. I don't know if any of you were here last year at Cleveland Connect 2024, but it is going to be have a panel discussion. This Marcia Pledger, if you haven't heard of her, was a former Plain Dealer columnist who wrote a column about my biggest mistake for more than 10 years. She did that. So she is coming. There is going to be a panel with about 4 or 5 panelists that she will moderate, and then take questions from the audience. There will be an opportunity for networking, so that you can meet other people who are starting businesses. You can ask questions about your biggest mistake. You can respond here. And this has a whole thing, and here is the schedule. There's a networking session. There'll be a presentation of some of our partners and the panel discussion. So you should have received an invitation in your email for this event. And if you did not, I am going to copy this link and put it in the chat here for you. So you can just click the link and let's see, let's make sure that that went. Okay, you can just click the link and find and go to the site and read it over, register if you like, and we would love to hear you. It is on September 18th. It will be from 5:30 to 8, and you'll be able to see all of that on the website. Let's see. Let me okay, there you go. There's the link. Okay. I'm going to stop sharing right here. And if anyone has any other questions, yes, the event is an in-person event, and it's going to be held at Tri-C Corporate College. And you can just click that link above if you haven't received the email, or even if you have, and register right from that page and see all the details about it. And it is in person. Any other questions for Liz until before we sign off? Liz, thank you very, very much. Really, this was just wonderful information. And we'll hope to have you again someday.
So much, Sharon. I appreciate that. And thank you everyone for your time.
Okay, thank you. Bye-bye.